Yo, price is crazy. So it went up to go catch what? I guess if we look maybe on 15, we'll see what it was going to get. But I already traded, man. I'm good. So yeah, let me show you guys. I actually recorded this, but it didn't record the screen. So I have to do it again. So all I did was this indicator lit timing. It shows, okay. So all I did was I come here, I look at my charts from 3 a.m., right, which is the middle of Asia. 3 a.m. South African time, Johannesburg. If you see here, see, I pick Johannesburg because that's where I'm from. So wherever you from, you're gonna pick that middle of Asia. So yeah, I start to look at the structure from the middle of that. So if you see that price went down, up, when it broke that, left liquidity there, I marked that out. Mark that liquidity out. I didn't really care about what happened in between. I only wanted the external structure. So it went down, left another piece of liquidity. So I marked that also. Um, and then it went down again, left this. So by the time I start trading at 8 a.m., right? So that's like quarterly theory at 8 a.m. That's like the second quarter of the 90-minute cycle, if I'm not mistaken. Yeah, I think the 90-minute cycle. So that's the second quarter of the 90-minute cycle on the quarterly theory. So that's why I trade from 8 to 11. 11 is like the end of the third quarter of the 90-minute cycle, which I count as my New York, right? And then the New York on the quarterly theory is 2, this is South African time, by the way, is 2 p.m., which is the second quarter of the, it's the second quarter of the 90-minute cycle, and it's the third quarter of the daily cycle. So if you know quarterly theory, you'll know that the most important times are the second and third quarter. The first and the fourth quarter are bad times to trade. You won't get the best price action because price doesn't really move. But yeah, so that's what I did. So this was liquidity, was supposed to grab it and push down, right? But it didn't really do that. All it did was it created a new structure and it broke that and left liquidity here. So we took this liquidity. So when we did that, this is how my trade happened. This was a F boss, as you can see, which is fake breaker structure, because it acted as if we still going higher. So people would actually enter here to take the TPs here or higher. So I knew that this was liquidity, was gonna get taken. Oh, and also, by the way, when it broke here, this was liquidity. So we marked that out. So we knew eventually it was gonna get taken. As you see now, it's taken. I was busy with something. I only came back now and I see that, oh, it's actually taken. So most people, New York, I mean, London, actually, I don't know. Like people, that's why these things are confusing for me. That's why I like quarterly theory, because it makes sense and yeah, it works for me. But yeah, as you can see, this indicator says London. This is London. It says it starts at 9, But like I think people, but as you can see, there was a lot of volume for that 9 from here to here. There's a lot of volume. We could have had a lot of pips. But anyway, we took that and we took that with some volume. I liked that, so I was like, okay, my bias was bullish. Went down to a lower time frame, and then I looked for my entry, and I saw a relevant breaker structure, and that was perfect for me. So I marked this order block out. You could mark from here, right? That's what we're supposed to do actually, because that's how we were taught. But yeah, you mark that, and I set my limit over here. Actually, I didn't set a limit. It was inside here, and I was doubting it. But I was like, man, if it hits my stop loss, it hits, bro. So after I entered, it pushed up. I was like, okay. But then it came back down. I was like, I was playing with my emotions. Then it pushed up again. So when it pushed up, there was when it pushed up here, there was a breakout, came back down, pushed again. After it broke this second structure, I put my price on break even. If you look here, it looks as if it took me out of break even. But if I come to my broker, the FTMO, which is where I was trading, and let me show you the history to show you that I actually entered. This is a demo, by the way, the demo account. Um, I'm gonna trade the real one. It's just I'm new to the strategy and I wanted to see it. So if you can see here, this is the same trade, right? This is, remember I said there was liquidity here. So this is where the liquidity is. And this is the reason why we entered, is this liquidity. So yeah, we entered here. If we go to the 1 minute, you'll see everything properly. 1 minute, you see the relevant breaker structure, which is here, and you see my entry. You see, this is where I entered. And obviously played with my emotions. It didn't get to my break even, right? Even though it came back down, but it didn't get to my break even. Why? Because I guess it's because I entered late. Oh, that's why. Because I entered when price was down here. So I was actually lucky because price would have taken me out on break even. You see, it did that on purpose. It came back down and it tried to take me out on break even. But I was lucky that I entered late. So it didn't catch me on break even. But yeah, what happened after? So I wanted to take my TP here. If I did, this break even wouldn't catch me, right? Because I wanted to take profits here. So I would be out early. Why did I want to take profits there? Because if you look here, okay, it's kind of messy now. If you look here, this is where the move started. That's how I like to take my take profits. So this is what started the move. So that's what I want my target to be. There will be a 1 to 2. That's chill, bro. Imagine if I'm trading $100,000 account and my entry is like $10,000. That's $20,000 profits, bro. Even though I'm gonna start with a 10,000 pound account, so the profit's only gonna be like 200 pounds if it's like my first trade, which is still good because yeah, it's still good, bro. We're gonna build up to where we wanna be. So I don't know. I feel like just to avoid, now that I'm gonna be starting, just to avoid a lot of things, if I'm gonna take profits up here, I shouldn't maybe put break even. But if I'm gonna take it here, then I should put break even, because now I got my 1 to 2. But if I'm taking it where I took it at this last point of liquidity, right? 1 to 3. But if I entered where I was supposed to enter, then I would have gotten kicked out on break even. So yeah, that's, if I'm not gonna respect my TP, I think this is a more comfortable TP, the first one, first point of liquidity. If I'm not gonna respect that, then I shouldn't put a break even, which is much more riskier. That's what I think about what I did today. I got lucky. So next time, if I'm gonna do this, I should be like, I'm all or nothing. all or nothing. You know what I'm saying? But yeah, I think that's it for the day, man. Oh, how did I feel when I entered? I felt very confident because I've been entering. I haven't been entering like physically. I would just look at the charts and be like, okay, I would enter here and I'd enter here, and price would actually go where I wanted it to go. So that gave me a little confidence. So now, before I entered today, when I looked at the charts, I was really confident. So when I entered, I was confident, even though what made me kind of not confident is that price was already deep into where I wanted to enter. As you can see here, this was very deep inside. And usually, what happens when price gets this deep is it just pushes way past your stop loss, you know. So I was like, man, I trust this. So if it does that, it's fine because I trust what I'm doing. I'll learn from it. That's what my emotions were. I wanted to stop, but I was like, nope, let me keep going, and it paid out. So yeah, I think that's it. Shout out. Thank you for watching. Peace.